The event was framed not as a diplomatic episode or a conventional strategic maneuver, but as an unmistakable signal of rupture. The military assault on Venezuela was described as something far more raw and direct, an act of forced appropriation at a moment of financial desperation. Under this interpretation, the operation was not aimed at political influence or regional stability, but at securing real resources in a context where paper was no longer being accepted. The central thesis argues that this moment marked a turning point in the history of the dollar. For decades, the United States sustained its global position through confidence in its currency. That confidence made it possible to exchange paper for oil, industrial goods, and foreign labor without immediate tangible backing. The assault on Venezuela was presented as evidence that this mechanism had stopped working. The use of force to secure resources was interpreted as an implicit admission of insolvency. A nation that can trade does not need to seize. A nation whose currency is accepted does not need to impose. The shift from negotiation to coercion was described as a signal that the underlying monetary system had failed. In this framework, the event ceased to be a regional conflict and became a global message. It indicated that the issuer of the reserve currency could no longer obtain what it needed through voluntary exchange. The privilege had expired. According to the argument, the world was no longer willing to accept paper in exchange for real assets. Thus, the assault was presented as a symptom rather than a cause, a symptom of a system that had reached its limit. It was not an isolated decision, but a desperate response by an empire that, having lost confidence in its currency, resorted to its final tool, force. For half a century, the dollar functioned through a privilege not written into any law, yet accepted by the entire global system. The United States could issue its currency and use it to acquire real goods, oil, manufactured products, technology, without immediate physical backing. This magic trick depended on a single condition: trust. That trust transformed paper into real purchasing power. Countries accepted dollars because they believed the currency would retain value, could be reused in trade, and was supported by a stable system. Under this structure, money creation did not appear problematic because external demand absorbed the expansion. The dollar was not just a national currency, it was the lubricant of global commerce. The video argues that this privilege has come to an end, not through an official announcement or formal break, but through a silent shift in global behavior. As issuance accelerated and debt exploded, the paper began to lose credibility. What was once accepted without question increasingly appeared as a weakening promise. When trust disappears, the mechanism breaks. The dollar ceases to function as a universal medium of exchange and becomes a liability others no longer wish to hold. At that point, printing more no longer acquires more goods, it only dilutes existing value. The privilege turns into a burden. From this perspective, the end of the dollar privilege is not theoretical, but observable. The world no longer exchanges strategic resources solely for paper. It demands something else: real assets, direct control, or power. The assault on Venezuela is positioned within this context as a logical consequence of that shift. Thus, the loss of trust affects not only financial markets, but geopolitical behavior. When currency no longer opens doors, the system reaches for other tools. The privilege that allowed consumption beyond real production runs out, closing a historical chapter of the dollar as the unquestioned axis of the global system. The collapse of that privilege became evident through the dynamics of debt. The level reached, described as $38.5 trillion, was not presented as an abstract figure, but as a mechanism that had stopped functioning. Debt was not only growing, it was growing faster than any realistic path to correction. Each day added billions more with no credible stabilization route. The critical issue was not the absolute size, but the weight of interest. According to the video, interest payments alone absorbed total tax revenue. This turned debt into a circular system. New debt issued to pay existing debt. Under this logic, the system no longer finances growth or services. It finances itself. This dynamic was described as sustainable only while external trust remains. As long as others accept the paper, the cycle continues. But once trust erodes, the structure becomes visible. The system can no longer hide behind growth or productivity. It is reduced to simple math, more issuance to cover past obligations. The term bankruptcy was not used in a legal sense, but an operational one. A system is insolvent when it cannot meet obligations without continuously creating new promises. At that point, debt ceases to be a tool and becomes a signal of exhaustion. From this viewpoint, massive debt is not merely an internal financial problem. It signals externally that the issuer can no longer sustain its position through voluntary exchange. When payment depends solely on printing, the paper weakens and credibility erodes further. Thus, debt was presented as the hidden driver behind behavioral change. It was not the immediate cause of the assault, but the context that made it inevitable. A system trapped by unpayable interest loses flexibility. When monetary flexibility is lost, solutions are sought outside the monetary sphere. At that point, the problem shifts from financial to structural. When a monetary system stops functioning, collapse does not occur instantly. According to the video, it follows a recognizable sequence. The fourth stage is the most dangerous, desperate resource acquisition. At this point, an empire can no longer trade normally because its currency has lost acceptance. Unable to exchange, it begins to prey. This phase is marked by a fundamental behavioral shift. Diplomacy and trade cease to be sufficient. The priority becomes securing strategic resources at any cost. Not to grow, but to survive. The logic is no longer economic, but extractive. The system seeks control, not cooperation. The argument holds that this pattern is not new. It repeats whenever a power loses its ability to sustain its currency as a trusted medium of exchange. When trust is exhausted, currency no longer opens markets. Military power replaces monetary power. Force substitutes voluntary exchange. The incursion into Venezuela was presented as a clear example of this transition. It was not an operation to stabilize a region or negotiate energy supply. It was described as direct appropriation, consistent with a stage where the system can no longer expect others to accept its currency in exchange for real goods. In this phase, resources take on a different meaning. They cease to be commodities and become collateral. Oil, gas, and minerals function as implicit backing for a financial system that can no longer sustain itself. Currency loses its original role and must be propped up by physical assets obtained through force. Thus, too, Stage 4 was not framed as an abstract theory, but as observable behavior when exchange fails. The video argues that the assault was not an excess, but a logical consequence. When trade ends, predation begins. And when that happens, monetary collapse shifts from future risk to unfolding reality. Venezuela was developed as a concrete illustration of this predatory phase. It was not portrayed as a random target, but as a vault of tangible value in a world where paper no longer fulfills that role. With estimated oil reserves valued at $17.3 trillion, Venezuela appeared as an energy vault accessible to a power unable to finance itself through traditional means. From this perspective, the assault was interpreted as the seizure of collateral. When a financial system can no longer rely on trust or credible future income, it seeks immediate physical backing. Venezuelan oil was presented as that backing, something that can be extracted, sold, or directly used to sustain economic and military machinery. The analysis emphasized that this behavior does not follow market logic. There was no price negotiation or exchange agreement. The resource was taken because it could not be purchased under normal conditions. That impossibility was framed as the true signal of collapse. When money no longer buys, force replaces contract. In this framework, Venezuela was not merely an energy supplier, but an example of how strategic assets assume an indirect monetary role. Oil ceased to be a commodity and became implicit guarantee for a system no longer supported by financial promises. This reading also broadened the meaning of the event. It was not only about securing immediate energy supply, but about sending a message that real resources take absolute priority when currency credibility collapses. The assault demonstrated that system backing is no longer abstract, but physical. Thus, the Venezuelan case illustrated how a declining empire redefines the concept of backing. When paper fails, the system returns to the tangible, and when the tangible cannot be obtained through exchange, it is taken. At that point, monetary collapse ceases to be financial and manifests as concrete action on the ground. The analysis then advanced to the next logical implication: silver. Just as oil was presented as a seized resource when exchange failed, silver was identified as the next point of tension once strategic reserves tighten, not as a distant hypothesis, but as a structural warning tied to its modern role. Silver was described as a critical input for modern warfare and energy infrastructure. Advanced weapon systems, electronics, communications, and technologies linked to energy transition depend heavily on it. Unlike other metals, it cannot be easily substituted without performance loss. This dependency elevates silver from commodity to strategic asset. According to the video, the pattern is clear. When a system can no longer obtain resources through trade, it identifies those essential to operational survival. Oil serves that role in energy, silver in technology and defense. As available supply tightens, pressure to secure access rises exponentially. The warning was not framed as a timeline prediction, but as a structural consequence. If force was already used to secure energy, there is no conceptual barrier preventing similar behavior toward other critical resources. The logic does not change, only the target does. This reinforces the view that the crisis is systemic, not sector-specific. Silver enters the narrative not through speculation, but necessity. When paper loses acceptance and exchange fails, strategic resources become the true backing of the system. At that point, control becomes paramount. Thus, the silver crisis was presented as the natural extension of the same process observed with oil. Not an isolated event, but part of a sequence in which monetary collapse drives systems to secure, by any means, the inputs that sustain power. In this context, silver ceases to be metal and becomes an unavoidable point of friction. The historical parallel used to reinforce this argument was the Roman Empire and the debasement of its silver currency, the denarius. During expansion, Rome sustained power through a widely accepted currency backed by real silver. While trust held, the empire financed armies, trade, and administration without systematic coercion. Over time, that base eroded. Emperors diluted silver content by progressively adding copper. The process was gradual. Each reduction seemed manageable, but the cumulative effect was destructive. Currency credibility collapsed. Prices surged, and exchange became chaotic. Inflation was not only economic, but social. The video draws a direct analogy to the modern silver market. Instead of physically debasing coins, today's system dilutes silver through paper claims that vastly exceed available metal. Apparent abundance reflects multiplied promises, not real supply. This paper excess performs the same function as debasement of the denarius, short-term financing at the cost of long-term trust. When too many claims compete for limited backing, instability follows. Confidence breaks through experience, not decree. As participants realize, not all claims can be honored. Roman history was used to illustrate the outcome. As currency lost value, the empire increasingly relied on taxation, confiscation, and direct control of resources. Monetary collapse preceded political collapse. Silver debasement was not a technical detail, but a catalyst for economic breakdown. By drawing this parallel, the video presented history not as anecdote, but pattern. When a silver-based currency is diluted, the system enters crisis, forms change, logic persists. In both cases, excess promises against finite backing produce inflation, distrust, and eventual rupture. According to the video, this condition is no longer theoretical. Unpayable debt combined with structural spending forces money creation as the only viable option. This is not stimulus or cyclical response, but avoidance of immediate insolvency. Inflation becomes not a side effect, but an implicit tool. This dynamic explains elite behavior. The video describes a massive migration of private wealth out of Western economies, the largest in history within the narrative. Those with sufficient resources do not wait for official confirmation. They interpret structural signals and act before restrictions emerge. Capital flight is calculation, not panic. For those unable to relocate capital or change jurisdictions, the situation differs. Fiscal dominance removes options. Purchasing power erodes steadily while financial alternatives remain trapped within the same system. Value preservation becomes survival rather than return optimization. The analysis emphasized that collapse need not be sudden to be effective. Gradual erosion suffices. Sustained money printing performs this role. Each additional unit dilutes existing value, transferring debt costs to the population. Inflation functions as a silent tax. Thus, fiscal dominance links monetary collapse to social behavior. Elite exit and domestic pressure are not separate phenomena, but parallel responses to the same condition. When a state can no longer fund itself without destroying its currency, wealth protection requires exiting the purely financial system. The conclusion focused on physical silver as a final response to a system no longer sustained by trust alone. Unlike financial assets, silver was presented as portable, tangible, and beyond direct monetary engineering. In an environment where paper value depends on increasingly constrained political decisions, these qualities become decisive. The reasoning did not rely on promises of rapid gains, but on silver's historical role as a store of value during monetary collapse. While elites escape through jurisdictional mobility, silver was framed as an accessible alternative for those who remain within the system and must preserve purchasing power without intermediaries. The concept of silver as a passport was economic, not legal. Its portability, divisibility, and historical acceptance make it a preservation tool when financial borders harden. In this context, silver does not compete with traditional instruments. It replaces them when credibility fails. The video concluded that currency death does not occur in a single day, but in real time, through accumulated decisions that erode trust. The Venezuela assault, unpayable debt, fiscal dominance, and monetary dilution were presented as components of a single process. The shift toward hard assets was not a trend, but a predictable response. The final message was not sudden catastrophe, but ongoing transition. As promise-based systems lose coherence, assets that cannot be printed or diluted regain prominence. Within that framework, silver appears not as speculation, but as the logical outcome of collapsing confidence in fiat money.